Thank you, everybody, and welcome to the Real Life Real Estate Investing Show. This is Season 2, Episode 2. Welcome to the 2023 Real Estate Collapse. Are you ready to catch a knife? That is the title of today's episode. We try to do everything in a humorous way, team, but we are going to try to deliver some value today and give you guys some facts about what we're seeing out there in the real estate market. We've gotten a whole lot of questions as to what's happening out there and what should people do in order to protect themselves. And that's kind of what we're going to attempt to deliver here today with some cold hard facts. And then towards the end of it, we got a very, very special person. He is been my insurance agent for a little bit now, and he will be sharing his insurance wealth of knowledge that he has after being a real estate insurance agent for many years here in the Florida market. As I mentioned to you guys, my name is Hector Hernandez, and I am a real estate fund manager as my daytime job. I'm also a wealth building coach here on Real Life Trading, and I have the privilege and honor of helping you all achieve your real estate success goals and your wealth building coach. Please do remember to hit like and subscribe if you're on YouTube. I believe we are being broadcasted live on YouTube, so please click that thumbs up. It just makes me feel warm and fuzzy when I see a bunch of thumbs up by my name. Luis, what do you got, buddy? Tell me about you.
All right, guys. Thank you for being here. Hello, YouTube land. I guess this is free week, so we got a lot of people. I'm seeing the participants. We have a whole bunch of new people. So very nice to meet you. My name is Luis Alejandro Lopez. I've been a real estate investor since 2009. I flip about 190 properties. And I'm one of real estate investment coach here in Real Life Trading. So let's get on with this. Have you opened your news feed lately and you see a whole bunch of bad news and everything's collapsing and we're all going to die and we're seeing a whole bunch of layoffs and everything? Is that going to affect real estate? How it's going to affect real estate? Are Chicken Little really in the house or not? So let's go over data.
Let's get a little poll going, Lou, real quick. Let's get a little poll. I think we got time. Let's get a 1 if you've seen some negative data on the news, some doomsday type stuff that's about to happen with real estate. Give me some 1s. If you've seen nothing and you see nothing but rosy positives, give me some 2s.
Man, I miss when my feed was just Star Wars and motorcycles. Now it's just bad news. All right, so before we go any over, let's disclaimer. We're just two guys on the internet. We think we know what we're talking about. However, if you decide to buy a home, if you decide to purchase something, if you sign on the dotted line, you are responsible for your actions. We're here to entertain you. We're here to educate you. At the end, the decision is yours. If you have any questions, reach out to us. We are live in Real Life Trading here, the second Friday of the month at 2 to 3:30, and the last Friday of the month, 2 or 3:30. And you can get us at let's put it over here now, since we're here.
Yeah, that's helpful.
Here, real estate at reallifetrading.com, or if you come into reallifetrading.com/RE, you're going to see a little real estate tag on the top of the screen. That's where we live. Okay. So we have a whole bunch of ones, correct? And what the
a whole lot of ones, and I did want to add something to that, to what you were saying, Lewis. In terms of the disclaimer, team, what we're doing is we're just simply sharing our thoughts and the way that we're operating our business. Lewis and I are out there day in and day out buying investment property. Is what we do for a living. Is what we've been doing for 10 plus years, and so we're constantly looking at data, and we make all our decisions based on data. Real estate is a lagging indicator. So we're looking ahead of what we see coming and making decisions today. And we're ready to pivot anytime this data changes. But as of all the research that we've done in the last, this year so far, in the last few weeks, we're still very, very confident of what we're about to share with you guys today. And we're going to tell you what, we're going to show you the numbers so you can see it. And at any time throughout this process, if we're going too fast, if you have any questions, please let us know, pop it in there in the chat box. That's what we're here for. We're here to share. All right, Luke, all you, buddy. Talk to me. What are you seeing out there?
We're talking about Chicken Little. First news that I got into my screen last week was that there's a historical wealth destruction in the United States in numbers, okay? Basically, the average portfolio of 60% stocks, they're facing its annual biggest loss in 100 years. Okay, this carnage is 44% of the globe, 44% reduction of all the wealth, historical wealth in the United States. It's bad, it's really bad, right? We see here. So from here, from the top to the bottom of our channel today, from this little bounce here, it's 44%, supposedly, right? Now, if you see the wealth creation chart or the total wealth and the American households, it's been an ongoing up and bullish trend. If we know something about, we learned something this week about trading and real life trading, is that usually the trends continue until you break a pivot. How far away are we from the pivot? Very far away. And which is this pivot? COVID. Okay. So we still need to erase a whole bunch more of the wealth before we go into a bear trend. But okay, let's keep going. Chicken Little's in the house. All right, we heard about layoffs. What about Microsoft, Netflix, Amazon, Meta, Google, Spotify? They all lay off people the past 2 weeks. So
yeah, talk to me about this unemployment, bro. I mean, how many people are out there having issues finding employment? Because I've seen a lot of headlines of a lot of layoffs.
The unemployment is really bad. Actually, we just had a report 2 days ago. And what happened with the report 2 days ago? Here, that's your unemployment rate. Historical unemployment rate. Okay, we're coming from the 50s. You see the record lows. Where are they? At 2.5%. Where are we? 3.5%. So historically, we are in one of the markets where there's most employed people. Now, again, there's discrepancies on how it's measured, the people that decide to retire early because of COVID, whatever, but there's still lots of jobs available. There's still people being employed more than the people that are being unemployed. So yes, there's been layoffs, there's been problems, or every time there's a layoff, people find their new jobs fairly immediately. Okay. So if there's no layoffs, it's usually because the companies are losing money, right? That's usually what I hear. We're losing money, we're gonna lose our hair, it's gonna be crazy. So we need to lay off a whole bunch of people because we're going and you're losing a whole bunch of funds and there's no profits and there's no nothing, right? Booyah. Corporate profits after tax. What did we say? There is no bear market until we hit what? Pivot. So are we really losing money? Are we really losing corporate profits? Negative. However, everybody expects a recession. Okay, now the recession is going to be driven by the news and everybody's expecting a recession, so everybody stops spending money, or is really we have some really bad fundamentals in the economy and everything needs to shrink. We don't know. But what we can tell you is that yes, companies, and that's what they do, they need to look, same way we're going to look, we're looking ahead of the data and we're preparing ourselves for what's coming. All companies are preparing for what's coming. So if they see a little shrink, next thing you know, they're laying off a whole bunch of people. But it's as bad as anybody saying, I don't know.
So let's address Paul's point here. Paul definitely makes a really, really good point, right? They have changed a lot of the ways that unemployment, a lot of definitions have been changed in the last 2 years, guys. And unemployment is one of those things that has been redefined. And so I fully agree with you, Paul, that it is probably higher than the Fed is showing here on their historical trend line. But it is pretty factual that just last week we got a number of initial jobless claims that actually went down instead of up. So there is less people applying for unemployment benefits as of right now. There has been a lot of layoffs, and a lot of what I've seen and what I've been able to study is that people are kind of just shifting from one company, from one position to the other. There's been those a massive amount of new job creation in the last 2 years, which is now starting to kind of taper off and to level off. And while it might be severely underreported, we are still towards the bottom end of the historical. So even if you add a couple of points to that, we are still in a relatively strong economy as far as we can see so far. Doesn't mean that it's not going to get worse. We fully expect it to get worse. The Federal Reserve, expects it to get worse. In fact, they're shooting for it to get worse. That's kind of what they want. They want to slow down the economy, without totally destroying it, right? That's what the soft landing is all about.
Mhm.
And what we're seeing so far right now, even in the market, what a lot of the market is perceiving is that soft landing might happen. I've been extremely skeptical of it. I continue to be skeptical of it, but only time will tell, right? We don't have a crystal ball. For some reason, Amazon didn't deliver mine last week. But I do, what we could see out there is there's still a relatively robust job economic environment with lots of jobs available and increasing wages.
So now
Let's talk about
what
some news,
really-
Lou. What do you got in terms of news?
More news? You really want more news? Here we go.
Let's talk news. Let's talk federal news, because this is the last meeting that the Federal Reserve had in December. We're expecting them to come around in the next few weeks, and we'll hear a little bit more.
Mhm. All right, so the Fed raised the interest rate 0.5 point to the highest level in 15 years. Okay, now the Fed is meeting again in next week, January 31st to February 1st. They're going to have another meeting, and we actually expecting another fund increase. However, you see how bad this looks? CNBC, boom. That is your effective rate for the Fed fund. So yes, it's been historical high for the last 15 years. You see it? However, we're still historically low compared to the rest of, from 1955.
And so one of the things that came out in that last Fed meeting in December was most of the Fed officials were thinking that the target rate was going to be somewhere around where we're at right now, 4.5, 4 3/4. But they've all basically come to a consensus. I think it was 17 out of 19 of the Fed officials are now seeing a 5.1 and above target rate. So that means that we absolutely have, I believe this is about 5 right here, right, Lou, if I'm not mistaken, if you put your mouse, we absolutely have a little bit more to go, which will probably put us in the 2006, 2007 numbers in terms of federal funds rates. Now, one of the things that I fully think that's going to happen when we do get there is we're going to linger there a little bit more than a lot of people are thinking. Many people think the Fed is going, and immediately going to reverse course and going to start coming down. I don't think that's the case. I think we kind of linger a little bit higher than most people expect because inflation is sticky. Sticky. It is going to be really hard to bring that inflation down. I mean, we've been pounding it for how many months now, and it's barely ticked down. We have a really, really long way to go to get to their double digits, to the 2.0 inflation rate that they're looking for. I see a question here from attorney Dan. Where can I find info on Vegas? Oh, okay, you put that there. All right, good job. Good job. Thank you, sir. And so this right here is inflation. As you guys can see, we are pretty high. Team, that is high right there. When was the last time we were this high? Way back here in the 80s. We barely got there in the 2000s. So what I think,
it's high.
Go ahead.
One of the things I wanted to point out, it's not that it's historically high, it's just the way that it grew so quick. Okay, that got everybody kind of by surprise. And what they're doing is they're trying to hit the emergency brake so this thing does not, explode like it did here. But realistically, we're not all the way up there. If you see all throughout the 90s and 2000s, that's the historical rate that we had before. Okay.
Yeah, and that's what they're trying to avoid essentially is this right here. This fake dip and then runs back up. So if you go back to the screen where you had your Fed fund rate, you'll see kind of what happened here in the 70s, right? Is we were high, then we dropped, and then immediately we had to go back up because they dropped too quick. That's why I don't think they drop quick this time around. I think they stay up there at that higher number, and really Jerome Powell has said this on multiple occasions. He expects to stay at higher rates for longer periods of time. But there is only so much that the United States, the economy can handle, right? We have a lot more debt these days than we did back then. So there's only so much, so high that we can go, and only so long that we can remain high for and still be able to afford paying those debt payments, because they are getting excruciatingly painful to pay. This is a slightly older article, but they were already thinking about this, and this was already becoming an issue 2 months ago. And we've had, I think, what, another 2 rate increases since then, if I'm not mistaken.
Mhm.
So it's going to definitely be an issue coming up down the road, probably sometime late this year, beginning of next year, when our debt payments become more than what we spend on military and what we spend on other programs that the government likes to focus on, right?
And the reason is this.
I love this one. This one is a little bit scary. So let's look at revenue first. Oh, you went right to the deficit. Come on, man, you gave the answer away, brother. All right, so this
is be scary, man.
This is what we, as a country, our revenue, right? Our income. This is for so far collected for fiscal year 2023. What do we spend, Lou?
Ouch. Let's see.
Pull out your calculators, team. Luckily for us, it does the calculations, because I don't think my calculator has enough zeros to pop this in there. Let's look at that deficit tab that you were showing a little bit ago.
Here we go.
All right, so this is essentially what we're short, basically, right?
Yeah. So basically, we have a big credit card that we're using more the credit card than we're paying every month. So it's okay. I mean, the United States has been like that basically forever. I mean, I think there was only a couple of times in past history where we had surplus. But what happens when your credit card interest jumps from a reasonable rate to a really high rate, Hector?
You got to pay more money for that debt. Think about this, team. It's not much different than when you get that 0% interest credit card. You know, you get that first 6 months, 12 months, you're happy. You hit the town, you go shopping, you buy furniture, you buy clothes, new shoes, but you don't pay it all off by the end of that 0% interest rate at the end of the 12 months. Mm-hmm. All of a sudden now, your $10,000 credit card bill is incurring a $1,000 a month interest payment, while you were paying $1,000 a month last month and bringing that debt down. Now that $1,000 just covers debt. Now you got to make an extra payment if you want to make a dent on that dent on the debt.
All right.
Yes, Ruby, so, you're absolutely correct. The young generations are going to have an absolutely tough time, unfortunately. Mm-hmm. Is what a lot of this points to, and a lot of the reasons why we are such advocates for buying assets and building your generational wealth through real estate. That is by far one of the biggest things that we're constantly out here preaching to everyone, to the team. I personally believe it has made a massive difference in my life, in my family's life. And I think the way to protect against that, the next generations, is to buy those assets that is going to continue to grow with inflation and is going to continue to hedge them for years and years to come and produce income and cash flow for them. Oh. And then Ruby says, and then the AI robots will take over the jobs. That is, yeah. We're not going to talk about ChatGPT here today, but it absolutely, AI is coming. There's a lot of people that are going to be displaced. So get your skills up, get your assets up, get your community involvement up. AI can replace your heart, your emotions, and your community that you build around you, and the things that you are able to do for others around you. AI cannot replace that. So that's one way to protect for sure.
All right. So what happens if the national debt is so high and the interest rates are so high? Then the United States starts paying more money in interest than the actual debt, and it spends more money on debt than anything else in the whole economy. Is that sustainable? I don't think so. If that will be sustainable, then I wouldn't have moved from Venezuela. So what happens? What's going to happen next? The interest rates are going to go up, are going to stay high, but they have to come down. The whole country, our whole economy, our whole growth depends on the interest rate starting to come down to regular levels. Okay, to regular levels. They cannot be higher than 7%, than 6%. So yeah, we're gonna see an extra spike, and then they're gonna stay there and they're gonna come down. because otherwise we won't be able to maintain the United States as we know it. Simple as that. So
Yep.
let's talk, let me get rid of this and let's talk a little bit about real estate now.
So before you go that far, just so that everyone knows, so far out there, the general consensus along the Fed officials is that in 2024 is when they expect to be able to start dropping rates again. And that could, again, get a little, push back a little bit more depending on how inflation reacts. We have heard multiple times from our friend, Mr. Jerome Powell, aka Jay Payne, that he is willing to inflict pain on the economy in order to bring down inflation. The longer inflation remains high, the stickier it becomes, the more it becomes the normal way of living, and the harder it is to bring it down. So they are definitely going to push as far as they can in order to make sure that that does not happen. Because what the last thing we want is a repeat of those really high inflation times that I'm a little younger, so I wasn't around back then, but some of the people that lived through the 70s and the 80s, they tell me that it was brutal. It was quite brutal.
Okay, so let's talk a little bit of real estate fundamentals. Here's what's going on. Forbes.
Let's go real estate. What we came here to do, right?
All right, 98 of the largest 100 largest housing market saw prices nosedive in September from 2022 peaks. Oh my goodness. All right, next one. Redfin.
Is that your panic face? Hold on, I want to see your panic face one more time.
Home sales slumped 35% in November. Can you believe that? Okay, biggest decline on record. It's true. I say it's not true.
And that's and we're not saying that is not true, team, right? But you go from an extremely overheated market to a mediocre, slower market, you're going to have a massive drop. It's going to be historical. We've had a historically hot market in 2021 and 22. So it's definitely understandable that a slowdown looks huge. So what we're trying to do here is show you the headlines, right? So we can see the difference between, the clickbait and what the facts are. We want you to see facts and not panic when you read these headlines. Not that it's not happening and not that we don't see things slowing down. It's just how deep and how bad is it gonna be, and how much of it is just the news trying to sell news.
And not only that, okay, Fannie Mae chief economist sees the house price dropping in 2023 and into 2024. And there's other warning signs of prices falling in your city. Okay, it's not falling in that city, or they're not falling in California, they're not falling in your city. So why do they do this? Oh my goodness, I go back. Last one. Oh, what does it say there?
Wait, are we recovering already? Wait, what's the date on that other article?
So wait. We have December 2022, and then all of a sudden we have a what? So let's get this straight. These people are selling information, okay? And I was warned not to use a bad word. So this is just clickbait. Simple. All the clickbait in social media that you're gonna see in your feed, okay? Yeah, Liam said 2 days ago, it's all good. It is all good. So how can we have the biggest slump in the last history of humankind, and all of a sudden everything's fine? So do not trust these things. These things are here to sell you what? Bad information. And how do they make money? By you clicking your mouse.
Clickbait.
Okay. So once you see a whole bunch of news that everything is bad, everything is wrong, and we're all gonna die, you're not gonna click on those news anymore. So what do? Okay.
So that now they got to flip it, right? Hey, I'm too sad. Oh my God, I'm going to hide under the covers. Wait, now let's give them some good news. So they click on it again. So again, that is so Liam states how many younger families can now afford a home. That is an absolute fact. We have a major affordability crisis in this country. And it's definitely, unfortunately, it's sad, and it has been predicted, and we'll get to a couple of slides a little bit later about this, that we are embarking on the largest generation of renters. It is being created right now. The lack of inventory, the prices, everything else that's going on is creating a generation of renters, which is where, unfortunately, landlords thrive. And that's what we're going to get to. You know, we are here to talk and to teach you all about real estate investing. So while it might be really terrible for that younger generation that's having a harder time buying a home, it is great for you if you want to invest in real estate and buy those cash flowing assets to, again, hedge your family and your next generation against inflation and against the debt and the tough times that continue to come down the pipeline.
Mm-hmm. All right. So where our conclusion is that we're going to see a slowdown. There's going to be a dip, definitely, for sure. But we're not going to be, the sky's not going to fall down on us, and we're not going to die. And you know, zombies are not going to take over the planet and everything. So let's go over the real data that we found here. Want to take it over?
Well, this is First American. They have a large amount of data. They are one of the largest data providers for title companies in the United States. I'm not even sure if they're worldwide or not, but I know for a fact in the United States, they do a lot. And so I recently went to one of the presentations, and this is basically what's out there right now. Over 42% of currently owned homes right now are owned free and clear. And obviously, the majority of this is that older generation, those baby boomers that, you know, bought their houses many years ago. They continue to live in there and pay it down little by little. But what that means, right? The whole preface, the whole thing that we're trying to show you guys here is why this downturn in real estate, this dip, if you would, right? We're all stock traders here, right? Is a buyable dip. Why we feel it's a buyable dip, why we're out here buying the dip, while we're buying it cautiously, and we are doing certain things that we'll talk to in a few minutes to kind of hedge our bets. We are still buying, right? We believe that this is a good buying opportunity, and we don't believe that this is a repeat of 2008 where everything crashes, because there's just so much more liquidity. And if we get to the next slide, I believe is where we talk about, you know, how much equity there is on there, right? So right now we got a ton of people who own their properties free and clear, and the housing build, right? New construction is down way below demand. So this is your supply right here. This is your demand right here. This is how large the deficit is. So in 2008, we definitely overbuilt. There was an overconstruction around this time. Those were different times. There was different economic conditions. It was an unhealthy borrowing debt market, however you wish to call it. It was just a lot of people that were getting loans that honestly should not have been getting loans. And there was a lot of speculation going on in the construction industry. And that definitely led to an oversupply. So one of the things that we look at on a regular basis in the cities, the counties, and the states where we invest in is supply and demand. This is a national statistic. So nationally, we are, I want to say is, a little over 2.5 years behind the demand curve. So we would literally need to continue to build 2.5 years worth of properties at the current pace that we're building it in order to catch up with this demand that's up here, right? That is going to be tough to do, especially because what happens in higher interest rate environments is builder confidence goes down and they stop building. Right now is actually one of the opportunities out there that I've recently heard of from some economists, is that there is a 60 to 70% cancellation ratio on new construction. So what that means is you as a buyer came in 6 months ago when interest rates were much lower, and you approached Lennar about buying a new home. Now things are changing. Interest rates are changing. You're like, hey, I don't think I can no longer afford the house, Mr. Lennar. I'd rather give up my deposit and bail out now than take that new construction. That's happening a lot in a lot of the markets, particularly out west. And that's got a lot to do with migrations. But that's an opportunity for us real estate investors to go in there and buy those properties at a very, very good price, at a discounted price from those builders, because they're going to be in pain, right? And they're going to have to cut bait. But what they're also going to do is they're going to build less. So this right here is only, in my opinion, and what I've read from many other economists that are way smarter than I am, is only going to get worse this year because builders have decided to slow down significantly in the last few months, and they probably will remain at a slower clip this year. Not just because materials are so expensive, and not just, but also because rates are so high, and again, that those buyers are less and less confident. Luisito, you got a question over here? Okay, you answered it.
Yeah, I answered the question.
Okay, so
Basically,
actually, I do want to make a point here. Al says that they're raising rents between 150 and 250 per month right now, and that's fair. I would love to know what market that's in and what that relates to, and you know, in terms of percentage to the rent. Is this $1,000 rent going up 25%, or is this a $2,000 rent going up 10%? That's just something I would love to know just for fun. But yeah, that's very typical of what we're seeing out there right now. Landlords are increasing rents, and in some places even more, really.
and you gotta
Here's the
remember,
other
guys,
thing that I think is going to continue to essentially make it harder I believe it was Ruby that made the comment about the young generation having a harder time affording new construction. The entry level supply, right? These homes right here, entry level, first time home buyers, the supply is dwindling. It's less and less houses. And it's not just because builders want to build these really elaborate, fancy luxury homes. It is mostly because price of construction is so high. It's gotten so expensive to do so that they are turning over a lot more of these types of properties right here in 2022. 2022 is the blue. It's the blue line. So notice the major difference in these right here, how much more supply we now have in the expensive column. What else you got, Lou?
all right. So what I have is I wanted to talk to a little bit about, we just spoke about the rents. I'll just say about the rents raising. Remember, guys, this is a market, and the rents are going by the market. If they can raise the rents and people still live in their units, they're going to keep raising the rents. It's the same thing that we just saw with the mortgages. The Fed raised the rate and the mortgages jump up to 7.5%. What happened immediately right after? Nobody applied for a mortgage. As soon as nobody applied for a mortgage, what happened with the mortgage rates? They came down another point. So it's supply and demand. Everybody, it's in there, whether we like it or not, to make a profit. So they try to squeeze as much profit as they can, and then they lay down and they lay off until the things is established a little bit. You know, it's kind of like a ratchet effect. You go a little bit up, and then you let go. You go a little bit up, and then you let go as much as the market allows it to. Okay, so let's look at other things. We definitely are seeing, you know, limited supply on entry-level homes. So that's really given, it's a problem for younger generations. Okay, but what's going to happen? Are they going to be able to afford it? I believe so. Why? Here's what happens. This is the forecast for 2023 from a whole bunch of economists and companies that they're way smarter, bigger, and, you know, have more capacity to research and do analysis than we do. Okay, so Realtor.com that tries to sell you ads to sell your house, they think that the things are going to go really bit higher. Okay, this one's, I'm not sure who they are. Morgan Stanley is thinking that the properties in 2023 are going to come down to 10%. The average, pretty much between everybody, is Redfin, Wells Fargo. They're all thinking the properties during 2023, they're going to come down between 4 and 5%. We do expect, okay, a drop in property prices about 10 to 20% from the high, okay? But we saw the prices. If we go from the high and you drop to 10 to 20%, if you drop 20%, it brings us to the prices of January 2021. So how much money are we really losing? Again, remember the trend, remember the curve. We're gonna have an adjustment on prices. The prices are gonna come down to a more reasonable levels, and the markets are gonna stabilize. The other thing that I wanted to mention is where everybody's talking about foreclosures and problems with foreclosures, and foreclosures are back, and we again gonna lose everything, and it's gonna be 2008. Here, homeowner equity keeps growing across the United States despite the third quarter slowdown. What does a slowdown means? That the prices are not going up 10% in 3 months. Okay, the prices are stabilizing. In some areas, the prices are going to start coming down again. You're going to have more demand, but the more supply than demand. Okay, and the prices are going to stabilize all over. But still, there are markets where the prices are still going up, right, Florida? We
Yeah.
did the research. We talked about it in the last class. We buy and we flip and we invest and we do everything, a lot of things in Florida. The Florida market, you need to look for locations or markets where you have positive job growth, you have positive population growth. I'm not going to do the same thing in Wyoming. I'm not going to do the same thing in Montana. But hey, Florida, for sure, I'll keep buying and holding and renting and flipping and doing all kinds of things.
Hey, before you go too far, I think we skipped one little part on that last slide, if you would, and then I think there was one more slide before we go too heavy into the into this. So
Oh yeah,
there you go. So all right, so
yeah,
what
that's
we
what I
just
thought.
said, right? We think personally, I feel like we're going to see a 10 to 20% correction in prices from the top, like Lewis said, but that is a very blanket statement, right? Real estate is a very, very local game and a very local economy, and it highly depends on where you are at and with the trends, like Lewis was just alluding to, in jobs and population. So here in Florida, and for the most part, with exception to a few areas that have seen a lot of construction, that's what I expect, right? Somewhere between 10 and 20%. So if you're in Florida and you can get something 15% below market value, you stand to not lose too much if the prices do continue to dip. If you're in California, however, different story. No problem, Liam. Thank you so much. We appreciate you being here. One of the things that we always look at, as we say, as Lewis was just saying, is population growth and job growth. One of the very alarming trends that we've been seeing in California is that population dropping, as you guys just saw in that prior slide. So one thing that you could look at whenever you're looking for a market to invest in and you're trying to do research, hey, is my market going to collapse? Is it going to take a harder hit than most other markets? Or am I in that 10, 20% category? You can look at U-Haul. U-Haul has this really cool data on their website, and it basically shows you those one-way trucks, right? That's how they can tell where people are moving, those one-way truck rentals, and where the influx and the growth has been. So take a look here at this beautiful chart on your screen. Did I mention that we predominantly invest in Florida? We have been in the #2 spot for a really long time, but look at this whole Southeast area and Texas, of course, you can't compete. But look at the guy coming from the back. And these guys right here, what an epic move. Virginia from number 31 to number 5, right? That, ladies and gentlemen, is areas that have seen a massive amount of migration in 2022, population growth, which means that you should see a steadier price decline, if you would, and a less not such a steep dip as you will in some of these areas out here that have seen a lot of that out migration going out, like we said, in California and some of those other higher cost states where the cost of living is higher. People are moving, not just for political reasons, team. It's not just politics and what you see on the news. Again, some of it is a lot of politicking, but for the most part, people are looking for affordability. A lot of you have said it in the chat. It's an affordability crisis out there. And it just so happens that most of the East and a lot of Texas just happens to be more affordable, the Southeast in particular. And Texas, Ohio is one of those pretty affordable markets that is just, it's making its way up. It's fighting its way, into the single digits. That's amazing. And same thing with Georgia. I've seen the amount of growth in Georgia. I've seen a handful of people leave Florida to Georgia in the last couple of years. I don't even understand how, but hey, my buddy sure did. And the state income tax does come into play, Ryan. Absolutely. Ryan says that the state income tax does come into play. Absolutely. That comes down to that affordability, right? You pay more taxes, you have less money to enjoy with your family to pay for rent. Your rent is already 40% of your income. Then you got to pay a bunch of taxes. Like, come on, guys, it can only go so far. So that was the last two things that I wanted to touch on here, Lou. I think that's the last slide. What's the next slide you got?
That's the forecast for the mortgage rate.
Okay, perfect. And then this is kind of what we've been saying, why we think that it is okay to buy in a higher interest rate environment because eventually it should come back down. And then you can refi and your not only will property values then at that point pick up again, but you should be able to get better cash flow on the properties that you bought at a lower price with higher interest rate.
Mhm. So I was going to talk about foreclosures, just a quick thing. And I'm a foreclosure expert. I flipped a bunch of houses, all purchase of foreclosure. And we getting the same information that the foreclosure activity doubles annually.
Scroll
Okay,
down a
yeah,
little.
it did double
There you go.
annually. You gotta remember, when COVID hit, all the foreclosures, all the evictions, everything was stopped. So even though it doubled from last year when they finally opened up foreclosures again in 2022, we're still not even to the level of 2019. One, and two, we have equity keeps growing across the United States. So what we told you guys over and over again, you have a home, you just refied a few months back and you took a sweet 3% mortgage. Are you really going to move? You have equity and you have 3%. Let's say that you need to move or you want to move. You're going to sell your home. You're going to buy the same type of home and you're going to end up paying what? $700, $800, $100 more for the same quality of home? Why? So unless life changes and life makes you change, so we're talking about downsizing, upsizing, kids, job moves, something like that, people are going to stay in their house and they have equity. So we don't expect, while the foreclosures always are going to come up, people, life happens to everyone. We don't expect the foreclosures to be, insane like they were over here. Okay, the whole reason why they have these foreclosures is because I'm not sure if you saw, what was the name of the movie that we saw the other
The
day?
Big Short. The Big Short.
It's people were buying homes 0% down and with 2 mortgages and nothing, and we cover your closing costs and we cover everything. You just sign here and done. That's not happening now. So if you have nothing, if you own nothing, if you put any sweat equity, if you put any sweat into it, you don't care about losing it. But if you have equity and you have mortgages, your next step is going to be worse. Why will you do that? So people will make the effort to keep their homes and don't be foreclosed and keep their payments on time, in time. Okay. Still, foreclosures have higher interest rates and higher foreclosure rates. These are the markets that have everything in Ohio. That's good. That have the highest foreclosure rates by zip code. But again, we don't expect that much to happen nationwide.
Very interesting, dude. We might have to go find some
Yeah, I have to move
opportunities
to
in
Ohio.
Ohio, man. It's making its way up. They're making good money, and there's some opportunities in these foreclosures, right? So, team, when Luis and I
Yeah.
see this, we can now go study the area to see why it's happening. Is this just a fluke, or is it just a great buying opportunities for investors like us? Because there is some people that are, that are underwater, and there's some foreclosure, and there's some more activity. And as long as the economy is strong in that market, we expect it to come back.
And the last thing we want to mention, it's this. Remember when we said that everybody has equity in the house and we said that properties were going, institutional buyers are buying property? It's when we talk about institutional buyers, we talk about companies. Okay, we talk about big hedge funds, we talk about mom and pop that they have opened a company, open an LLC to buy their first rental. Okay, so yes, investors are still sweeping a lot of properties in the market, and everybody expects the properties to be swept. So why would
I want you to
what's
this
your
one right
action?
here. Let's focus on that right there. Look at that headline. 40%.
40% of all single. But institution, does it mean it's going to be BlackRock only? No.
No,
It's going to be either one of us with our LLCs and our companies or institution. You don't buy usually investment property in your own name.
yeah, I mean, they're referring mostly to the big institution, the big Wall Street guys. We definitely are right there, second in line with those guys. But the main point is, team, that the reason why that is happening is this, right? Is rent growth. We just talked about it. There's an affordability crisis. Less people can afford. There's more renters, a renter nation. And these big hedge funds like BlackRock, like Luis just alluded to, they have all this data. They see this way ahead of many of us. They have analysts that all they do is look at data. And so they are gearing up to buy more and more. It was a record year in 2021. So many of these single family houses got snatched up. Our next guest is going to tell you about some of that, and how that definitely has happened here in Florida too. And well, we seen it. Not that long ago, there was a news report last year. An entire brand new construction subdivision got snatched up by one of the big hedge funds here in Florida. I believe it was Melbourne, if I'm not mistaken. Brand new subdivision was going up. They bought up every single pre-construction home. It made sense to them because the cash flow is there, because the rentals are there. And that is essentially kind of what we see as well and what we are doing in our business. So, Luis,
All right.
let me ask you a question. You gonna be buying some nachos, bro? You buying some dip?
Buy the dip? Of course, I'm gonna catch that knife for sure. So let's do, actionable things. Let's see what we can do now. First, look at your market. If you're in a market that has a, loss of jobs, loss of people are moving out of there, look into a new market. Okay, people now we're in the age of technology. We got Zoom, we got FaceTime, we got WhatsApp, we got property managers that we always tell you get a property manager. So if you want to invest in real estate and your market is not the best and you don't want to move, you don't have to move. Invest in another market. Okay. Second thing that you need to do, make sure that you buy properties at a discount. Okay? We talked about it a million times. We show you how to look for them. We show you how to calculate for them. Buy properties at a discount. That is going to be your equity. You make money. That's all of that. You make money when you buy real estate, not when you sell it. The lower your price, you need to negotiate down. You need to get yourself a good agent, or you need to do it yourself. Anyway, try to buy a property at a good discount so you can always improve and sell for more or rent for more. Third thing is very important. If you plan for renting a house, buy a house to rent and invest like these people are doing, make sure you cash flow from day one. Do not buy a property just thinking that, okay, cash flow, but I still have to put $200 every month because it's a great investment. Okay, that happens in 2008, 2009. Don't do it. If you buy a property now, you buy well, you buy it low, you make it pretty, you rent it out, you cash flow from the beginning. In 3 or 4 years, once the interest rate comes down again, you refi and you'll have even more cash flow. That's the name of the game. So make sure that since everybody's scared, because we show you why, use that as a tactic to buy properties cheap. There's always, in any market, there's properties that need work, there's property that need value add, and there's same thing, life happening to people. So that's what you need to do. If you need to find your needle in a haystack and your haystack is too big, well, move to a smaller haystack or one that has more needles in it. Simple as that. Okay. So conclusion. Do you want to say a conclusion?
Yep. Conclusion. That we are essentially using a lot of this data to drive our business team. Like I originally alluded to, that's exactly what Luis just said that we're looking for, right? We're looking for markets with growing population, we're growing job opportunities with growing income because prices will have risen and they will continue to raise, to go up. And so that's kind of what we're tracking. We're tracking this data, and that's what we suggest that you do if you are buying a property. Luis, what about if I'm buying not an investment property, right? That was great advice that you gave. If I'm buying a rental, make sure I cash flow. What about if I'm buying a home? Do I wait or do I buy it now?
Buying a home? Okay, simple. If you love the home, if you can afford the home, and you're planning to stay there for 5 to 7 years, go ahead and buy it and enjoy it. Simple as that. If those things don't happen, don't buy it right now or buy something else. There's always another opportunity. There's always another home. And like I always say, do not fall in love with the house, fall in love with the numbers. Make sure the numbers make sense and then jump on it. Boom.
Bingo.
Okay.
I love it. That's exactly what I would do. The one caveat there that I would do is just, I would be a little bit more patient. That's it, right? Whereas a few months ago, if you needed to buy a home, you had to come in aggressive, 50 grand over ask. Now you get to be choosy, right? Yeah, I like that one, but I'm going to offer what I can afford. And if they take it, great. If not, I'm going to buy the one right down the road, because there's going to be a little bit more inventory available. So you get to make a slightly less emotional decision. But like Luis said, if you absolutely love it and you're getting a reasonable price, by all means, just make sure you're there to enjoy it and that you can afford it. It's a home. It's not so much a cash flow play. Before we move on to talking about Vegas, I believe is our next slide. Lynn Peters asked, Hector, do you buy properties with HELOC? And my answer is, yes, I have sometimes, and when the price is right, and when my HELOC is available, and not in using another investment.
But yeah, that's
But
the
yes, I
strategy.
do very much use HELOCs to trade in and out of properties, in and out of projects. And, you know, sometimes it's rehab money, sometimes it's acquisition money, but they're there. They're a great tool. I use them a lot.
All right, so let's talk about this. We been enjoying the free week? I hope you have. We have a lot of people in the chat. We have a lot of people in YouTube. The next step, it's you want to improve your trading. You want to improve basically everything that we show you for the past week. Here it is. We're going to Las Vegas, everybody. We're going to be there from February 26th to March 1st. There's a new discounted price, $22.95. I put the link on the chat. Hector, if you can find it up there and put it back again. The link is on the chat. If not, you go to reallifetrading.com and you can find it there. The hotel is fairly reasonable. And the beautiful thing is that we are going to be doing a real estate session on Wednesday. The Wednesday afternoon, we're going to be talking about a few things about real estate, why you should invest in real estate, how to do the BRRRR method. And then I'm going to go deep into how you buy foreclosure properties. And there are not that many. Again, you know, the haystack is still there. So join us. This is the basically retreat. We're going to be talking about options. I was told that if I mention shares in the retreat, I'm going to get smacked in the head. So please go ahead.
Options
Go ahead.
retreat. This is a retreat like no other team. And this is when we're done pitching. We're not here to sell. We love you all. We hope to see you all and get to meet you in person and give you a big old hug in Vegas. We can talk options. We can talk real estate, and we can most definitely talk roulette. Why not? Right? There is a skill to it. You know, our fierce leader, Jeremy, has a strategy for it because, of course, he has strategies for everything in life. He's amazing. So I hope to see you all there. Now, Luis, let's go to our esteemed guest. Ladies and gentlemen, we have the amazing, the one and only Mr. Greg Martin here on the line. Hopefully he is available and in front of his computer. Greg, are you here?
I am.
All right, Greg, yes. Welcome, buddy. We appreciate it.
Yeah, I'm glad to be here. It's nice to meet you guys.
It is absolutely fantastic to have you on here. So, ladies and gentlemen, like I mentioned before, Greg has been my insurance agent for a little bit now. I don't even know how long, but he's amazing. And I constantly refer him out every chance that I get. He has an immense amount of knowledge when it comes to insurance. And Florida insurance for that matter. And with all the hurricanes and all the stuff that's been going on recently, and a lot of people have been sending us a lot of questions about investing. Hey, is it still okay to invest in Florida? Is Florida a dead market? Is the federal is the Fed going to kill the real estate market, and a hurricane is going to completely destroy Florida market? So we're here to essentially debunk those ideas with Greg. He's going to tell us the facts. One thing that Greg does is share facts, and he knows the facts really well. So that's basically what we're going to do. We're going to give him the stage and allow him to share his prior experience. Greg, you can try again. I think I just allowed you to do that. There you are.
There we go. You can see me now?
Absolutely, man. What awesome. A handsome man. Welcome.
I don't know about all that. Thanks for having me, guys. So yeah, Florida insurance has been a hot topic for probably the last 3 or 4 years now. Everyone asks what's going to happen with it. Where's it going to go? Is there any positive signs coming? And recently we had a special session up in Tallahassee in December, and that's probably the first change that we've seen that the insurance executives have been positive about. It's supposed to reduce some of the litigation we're seeing here in Florida. Hopefully that'll lead to some changes. So usually they say it takes about 18 months for those changes to filter through and actually see changes in the availability of insurance and the insurance rates. But you mentioned hurricanes. That's one of the things everyone just assumes, hey, we have hurricanes, that's the problem, right? And that is like the first level of the problem. We have hurricanes. They do cause legitimate damage for storms, roofs, all of that type of stuff. What's happened from there that caused a lot of these problems is the roofing companies have figured out ways to advertise to go around and solicit for those. So they'll say, hey, we were replacing the roof of your neighbor down the street. Let me let me inspect your roof, see if you have storm damage. And they go up there, they always find storm damage, or with certain tools, they have ways to make storm damage. And so then they come down, and the pitch is good. If you aren't in insurance and you don't know any better, you would think it was good. They say, hey, just sign this form. We'll take care of everything for you. You'll just have to pay your deductible. And that sounds great. What they don't tell you is that if your roof is going to be like a $13,000 roof, they're going to bill the insurance company like 30 grand. And if the insurance company says, hey, we're not paying 30 grand for that, they say, cool, our attorney will see you in court then. And it'll turn into like a $60,000 claim. So that's where a lot of the problems come in. The last stat I saw was that Florida has 8% of the property claims and 79% of the property lawsuits across the country. So
wow, can you repeat that one more time for me?
Yeah, Florida has 8% of the actual property claims and 79% of the lawsuits related to property claims.
Wow, that is insane.
Now, if you talk to attorneys, they'll tell you it's because the insurance companies don't pay their claims, and that's the problem. And there's probably examples of that, and the insurance companies don't like all the attorneys getting involved because then they have all the attorney fees that get added on and things like that. So one of the things they changed in December session is what's called one-way attorney fees, which is where if you lose, you still don't have to pay attorney fees. The insurance company pretty much covers all of it. And so there was no incentive to not go to court and not do a lawsuit. So that change should help cut down some of that 79% and make it more in line with what the rest of the country sees. And they also allow companies to require arbitration now. So you may see that start to come into the policies. I know a few companies were trying to put that in where you go to arbitration instead of lawsuits. So we'll see. We'll see if that helps. And again, about 18 months down the road is when we should see some impacts from that, whether positive or negative. We have to see, number one, they've passed some of this stuff in the past, and then it gets challenged in court and gets thrown out and it's unenforceable. So number one, can it withstand legal challenges? Number one. And then number two, does it have the outcome that they think it's going to have, or did it cause some other unexpected consequences that now we have to address that? So that's kind of the high level overview. I'm sure you probably have some specific questions that you want to address, and anything that comes up.
I appreciate you sharing that, and especially that stat. That's mind blowing. That's mind blowing.
Right.
All right, Greg. So tell us a bit about yourself. Okay. Are you a real estate investor as well? Which areas do you invest in? Tell us a little bit about your journey.
Yeah, so I am a real estate investor myself. I've been in insurance since 2006. I worked with Liberty Mutual in their national service center. So I saw policies all over the country, all kinds of things, whether it's Midwest, California, Northeast, we did policies all over, but they don't do a lot of insurance in Florida. I never quite knew why. And then when we opened our agency, that's when I kind of found out. But I'm a part of a couple of real estate investor associations here. I have rentals over in Polk County, Lakeland area. So I'm part of PC RIA and a few of those groups there. I try to stay within 30 to 40 minutes of my house here in the Tampa Bay area.
That's great. And guys, when I first talked to Greg, when I first met him, one of the reasons why I decided to give him a shot was that my prior insurance agent is great. He's still my friend. I still deal with him on some personal properties, but on my investment properties, Greg knows, he walks the walk, he talks the talk. He has the same pain that I have as a landlord, as an investor. And so we were able to see eye to eye. And I know that he's out there hunting for the best policies for himself as well as me. So kind of one of the things that I always advise you guys is when you're out there looking to build your team, and an insurance agent is one of those people on your team, try to find people that do similar things to what you do. If you're looking for a realtor, try to find a realtor that's also an investor. You want an insurance agent, try to find an agent that does some investing. So they're going to see eye to eye with you. They're going to understand your pain.
Absolutely.
And another thing that I want to mention is that if you see in the slide, he just mentioned as well, he's member of the Real Estate Investor Association, his local Real Estate Investor Association. Remember, real estate, it's team sport, basically. So you need a team, you need agents, you need contractors, you need insurance agents, you need attorneys, you need all kinds of things. The real estate investor, your local real estate investor association will be the best place to start building that team. Okay, so
absolutely.
That's why I mentioned put it on this leg.
Yeah, that's the last rehab I did was an old wood frame house. We redid pretty much everything. And that's where I found almost all of my contractors, handymen, everyone that we used on that project.
Okay, so I got another question for you.
Sure.
We're all investors. We're all rehabbers. We all either flip or rental. So what's the difference between a short-term rental insurance? What's the insurance for rehabbers? What's the one that we need for rehabber for a short-term rehab?
So on short-term rehabs, you're going to have fix and flip. It's going to be like vacant insurance, vacant under renovation. Depending on the extent of the renovation, you may have a builder's risk, but you want to make sure that you have that type of policy that's going to cover a home that's vacant. It's different risks for those than like an occupied rental. You know, if you have a regular home policy or landlord policy and you have a water leak, there's someone there that's going to know to turn the water off and report that. You know, a vacant house, if there's no one checking on it, that water might be running for, 3, 4, 5 days, things like that. So it's a different risk for the insurance company, and there's different companies that will write that coverage. In Florida, most of the companies will do regular coverage, but they don't include water damage. And also it's usually actual cash value coverage on the structure, not replacement costs. That's one of the big differences there. There are a few companies out there that will write it. I don't know if there are, who you guys usually use in other parts of the country. I know a lot of investors like NREIG. We have a similar program, RE InsurePro. The problem for us here in Florida is that they are not taking any new Florida properties right now. So hopefully they'll turn that back on in the future. They do offer replacement costs, so you can get that on the existing structure when it's available, but it's not available here in Florida right now.
Can you elaborate a little bit more on that? What's the difference between actual cash value and replacement cost? That'd be great.
Sure. Yeah, that's a good question. So, let's say you're rehabbing a 1970s house. You're going to be putting new stuff in it with your renovation, but some of it there is still older. So they're going to take how old, if you have a fire or some type of claim, they're going to take how old that structure is or those components that are impacted, and they're going to depreciate it based on its age, condition, and expected life expectancy on it. Replacement cost isn't going to do any of that depreciation. It's going to give you the value of what it would cost brand new. So if you have 1970s Formica countertops, they're going to give you the value of 2023 Formica countertops. They aren't going to say, hey, you only have 3 years of life left, so you got $50 in coverage on that or whatever.
Gotcha. Okay. And so we absolutely want to go for replacement cost whenever possible, right?
Replacement when you can, absolutely.
Awesome. And it does, obviously, it's not always, because you and I have this conversation very frequently whenever with the different policies, you absolutely just can't.
Right.
But when it's available, it does cost a few bucks more, but it does make sense because, like, Greg just said, you got a 10-year-old roof, insurance says, hey, there's 5 more years left on it. Well, they're only going to give you that depreciated value, which is not going to be great if they're only going to pay you whatever 30% of the roof cost versus 100%. So it might make sense. A lot of the time for us, it usually does make sense to go replacement cost whenever possible.
Yeah, when possible, definitely. Like I said, here in Florida, that's hard to find these days. That's another thing that's helpful if you're using, I don't know how you're financing your deals right now, but if you use hard money or outside lenders, you want to make sure you know what their lending requirements are. Some of the investors I've worked with lately are using hard money, which is perfectly fine, but sometimes they have lending requirements that are very difficult for the Florida market right now. They want replacement costs, they want water damage coverage, they want, all these things that there's just not a market out there for them. So sometimes they're willing to adjust those a little bit and sometimes they aren't, but that can really impact your deal, whether we're able to find the coverage that your lender's requiring or not.
Okay. One quick thing that I wanted. Okay, go ahead. I wanted to ask also, because we have a lot of new people here from YouTube. What is a hard money lender?
So hard money lender is going to be not your typical, it's not Wells Fargo or Chase or any of your normal institutional lenders. It's usually going to be a company that's going to loan money based on the asset. So they're going to see how much the property ARV is, after repair value, how much repairs are needed, and then they're going to loan a percentage of that, usually at a higher interest rate than your regular institutions, but they won't require the same like income verification, all of that type of stuff. They're going to basically lend based on the numbers of the deal.
Great explanation. Yeah, it's an asset-based lender that us investors use many times because of those lighter restrictions on documentation and their ability to fund weird deals, if you would, not your cookie cutter deals, homes that need a lot of rehab versus, you know, your typical Wells Fargo lender is going to want the house to be in good shape, the roof to be in good shape. Hard money lenders, so long as you have the experience and the reserves, they will make that loan. And as long as their value of the property is much less than what they're lending you, typically you want to be all in at below 70% of after repair value, which is the full home value once you're done with it. And so that's why they don't care so much about your income necessarily, as long as you have a decent amount of reserves, you have decent enough credit. They all have different requirements. But that was very interesting what you were saying, Greg, in terms of the fact that those requirements are just causing an issue now with the lack of insurance availability, which is not something that you know, we've encountered recently because we haven't been using that many of them. But that's what can you tell me a little bit more about those challenges that you're seeing? How have you been able to maneuver some of those? How have you been able to still get your or have you seen deals fall off the table because you couldn't get the insurance that the lender was requiring?
That's a good question. So the one that comes to mind, well, so two things that I've come across. So the first one is sometimes they'll say, hey, this is Florida. We know we sent you the lending requirements for the rest of the country. Florida's a little different. So do the best you can. And I trust that you know what you're doing. Send it to me and we'll see if the numbers work. Like that kind of thing. It was a little less formal. But if you just went off the sheet they gave you, we never would have known that. And so we were shopping for all these other policies. And it was like, out of their 4 requirements, we could get 3 of them with like 4 different companies, but we couldn't get all of them with any of them. So that was tough. The other problem we come across from time to time is these companies they have their requirements, but they don't know insurance. So like this one company was like, yeah, we always use this one carrier. I'm like, well, that's the same policy I'm quoting for you, but it's actual cash value coverage. It's not replacement cost. And they're like, well, we take it. And so we'll just use it over here with this other. I don't know what they were doing. I think the other guy just wasn't telling them it was actual cash value because it didn't say it anywhere on the paperwork. But if you knew, I'm like, it's the same thing I'm writing. And basically the customer was having to pay way more premium because they were making him get higher limits that he didn't even need because it was going to be actual cash value anyways. So, you know, it's helpful to work with lenders and agents that know, you know, what's going on, try to work together to make sure that they can agree on what terms are there.
That goes to my prior point, right? A non-investor friendly insurance agent would have just not had an answer for that. Yeah. They would have probably been stumped and just stuck at point 1. But because you have that experience and you work with other investors and you're an investor yourself, you're able to kind of guide your clients a little bit better. So that's awesome, man. That's definitely really cool. Lou, you got any questions? I know you had some questions about some short. You're on mute, buddy. It's hard to hear.
Yes, I got another question for Greg. You're an investor as well. So which areas, I mean, we always preach Florida, we always preach, but in which areas are you seeing the most movement on investors right now?
In Florida?
In Florida, yes.
Oh man. So I work with people all over the state. So there's not necessarily one area that sticks out over others. Okay. Like I said, I'm pretty plugged in with the PC RIA group, which is Polk County Real Estate, and that's a lot of buy and hold investors in that area. And I also work with Tampa RIA, which is a lot of fix and flip people in Pinellas County, Tampa, Pasco, those areas. It's more fix and flip and less buy and hold in those. It seems like the more coastal you get is either more fix and flip or short-term rentals. It's a little harder to buy and hold, at least at this time, because the prices are inflated and the costs are inflated some. So until that stabilizes, I think it's harder to find those long-term buy and hold deals in those, you know, quickly appreciating areas.
Gotcha. And another thing, now that you mentioned short-term rentals, we've seen a lot of people doing the buy and hold, but instead of doing the regular landlord thing, they're doing the Airbnb and the arbitrage or renting to someone else. So
Mhm.
what's the difference between having a policy for a short-term rental as a regular landlord? Do you cover more things? Do you need to be aware of more things? How
Yeah,
does
so
that work?
that's a good question. So kind of like we talked about with the vacant homes, your Airbnb is going to be a different exposure. So, your long-term rental, you have one person living there. They're going to live there all year. They know about the house. They know all the details. They aren't coming and going. Short-term rental is more like a hotel. You're going to have people coming and going, different people all the time. They don't know any shut-off valves. They don't know anything about the house. If something happens, are they going to report it right away? We don't know. So there's a lot of companies that don't do short-term rental insurance. And then there are some companies that specialize in it. So one of the companies that specializes is Proper Insurance. That's the company that is recommended by VRBO. And that is a company that we can write with. I believe they do the entire country. So that can be beneficial to everyone. Here in Florida right now, they're not offering wind coverage. And that's one of the hard things about short-term rentals is finding wind. If you're in an area that Citizens will write, which is usually very coastal, very high risk, they actually are pretty affordable in their wind coverage, but they'll only do those higher risk areas. The areas outside their wind eligibility, ever since Hurricane Ian, has been very difficult. Like in Largo, which is Pinellas County, it's on a peninsula of a peninsula. I've been getting quotes for like $16,000 a year just for the wind. Like it's crazy. And I'm like, I know that this is not going to work with your numbers, but like, this is the only one we're getting right now. Like, I want to show you that that's what we're finding. But if it's in a Citizens area, Citizens is usually like 1,200 to 2,500. So usually a lot more affordable. And then you pair that with a regular policy that excludes wind. And the proper ones, at least here in Florida, usually run, most of the time we see them between 2,000 and 3,000 for that. They do have some specific coverages on it that is nice. They don't have any occupancy restrictions. So if you want to go stay in your Airbnb for the weekend or whatever, you're allowed to do that. They know it's going to be vacant at times, so it has vacant coverage, and they know there's going to be people coming and going. So that's good. They also include some incidental liability coverage. So like if you have kayaks or bicycles or anything like that, that the tenants are able to use, they have some liability coverage if something happens and they're trying to sue you for that type of stuff. So there's some good benefits there. One of the big things I come across is people ask me, well, I just have a regular landlord policy. Isn't that good enough? My insurance company hasn't done it yet, or they haven't given me a hard time. And one of the things I always say in insurance is it's not a problem until it's a problem. If you have long-term rental insurance and you have a little like $1,000 claim, they'll probably pay it. No big deal. But if that house catches on fire and then they search and they find your listing on Airbnb, and it's going to be an expensive claim, and they can say, well, hey, you didn't tell us about this usage. If you did, we wouldn't have written the policy. Then it's an issue. And that's the stuff you want covered to begin with. So you don't really want to mess with having the wrong policy and just assume it's going to be okay. Because you won't necessarily find out till the back end. And that's when you don't want to find out about a problem.
That's the worst time to find out, right?
Yeah.
We were looking, because we're looking to do some Airbnbs here in Georgia, and we were looking at some policies. They also include liability up to $1 million if anything would happen to the guest. Some of the policies will cover liability if somebody sues you, one of the neighbors or homeowners association, things like that. So it's very comprehensive. More, I guess they're not as scared on the damage to the property. They're more scared of what can happen with all the traffic of people in and out.
Right. Yeah, because like hurricane, the occupancy doesn't really matter for hurricane. Like the roof is going to have damage from the wind, whether it's owner occupied, landlord, or short-term rental. But it's more of that coming and going, trip and fall. They aren't familiar with it. Some type of party that someone gets drunk and falls or something like that, and then there's a lawsuit. Like the liability is usually where the bigger concerns come in. And then the vacant part of it where you could have, water that's unreported, that's been leaking for a long time, that type of stuff.
Got you. All right. Now, another quick thing I want to mention, guys, not so much for you, Greg, but we're talking about short-term rentals or Airbnb. We have covered those classes, basically, we have, if you come to real life trading, if you come to real estate, this is our page, this is where we live. Hector, my buddy, is there. Then, you have the ugly mug here. And you have mentorship information. We offer mentorships. We'll go over that later. But if you go to the bottom, we have plenty of videos, free videos on YouTube about short-term rentals, how to choose your contractor, how to invest passively in real estate and syndications. Everything is down here. So please come over. You're going to see them all over the place. We have probably about a year and a half of content already. No, I don't want to talk to anybody. You have a year and a half of content where we explain. We interview a person. They doing 7, 8 Airbnbs in Fort Lauderdale area, and they were great. So that's got that here. Wholesale explaining. No, I'll find it. They're here anyway. Okay, so look into the playlist. You'll find a whole bunch of information there.
Hey, Greg. So team, by the way, if anybody has any questions for Greg or us, please fire them away in the chat. That's what we're here for. Greg understands insurance, not just in Florida. So if you have any questions, he probably might be able to answer it, even if it's somewhere else. Please drop it in there. So I see all the points with the Airbnb and the short-term rentals, I should say, not just Airbnb insurance, and why they prefer to split it up. But how is that different than the landlord policies? Are you also struggling to write landlord policies right now with wind coverage? Have those guys decided to split them up?
So
I know mine have gotten ridiculously expensive. That's all I know.
Yeah, so landlords have gotten expensive, and there's gotten to be a lot less options. So like I have a few options that are good for, and they're like, yeah, we'll write 2005 and newer or 2010 and newer. And I'm like, that's not a rental house, except, maybe for BlackRock or something like that. That's who's buying up all the newer houses. Some of us probably have some of them maybe in our portfolio that we found a good deal on, but most of the time it's older houses, 1970s, 1980s, older houses that have been remodeled that you put a good tenant in, and that's great. On the older houses, there's not a lot of companies writing those right now, especially if you're using any entities. Citizens is where a lot of them are going these days, which Citizens has some of its own limitations, but it is set up to be kind of the insurance of last resort for Florida. They don't offer short-term rental coverage though. So when we're talking about short-term, it's not an option except for their wind only if you're in that eligibility area. But they do long-term rentals as long as they're annual leases, those types of things. If you have it in an entity like a trust or an LLC, they don't do liability coverage on it. So we can do a separate liability policy, but they will cover the structure. We can go into some of the limitations if you want on that, but that's all going to be specific to Florida, of course.
Yeah, we could definitely touch on a couple of those limitations. And then also, if you would circle back to some of that liability insurance, because, where we're covering property and things like that. But I myself have additional liability policies on top of policies because, I've talked to you about it. And So if you could dig into some of the limitations as well as why it's wise to have additional liability insurance sometimes, or what you recommend is a good, acceptable liability insurance.
Yeah, absolutely. And I think Lynn had a question there about LLC and trust insurance. So every company's different on how they'll handle that, Lynn. So some of them will write it just normal with a LLC or a trust. Citizens, for one, will write the policy, but they won't do liability coverage. So you have to pair it with a separate liability. Other companies won't write it at all. And then some companies don't care. Like that's one of the reasons a lot of investors like the NREIG program, because they'll do land trusts, LLCs, corporate, like they don't ask a lot of questions and they don't worry too much about it. So they're very convenient. They aren't always the best option price wise and things like that, but there's definitely some good convenience options with them too. So, and I think they do countrywide. They're not doing Florida right now. So limitations on Citizens. So the first ones we'll talk about would be owner occupied limitations and investor limitations. And that's going to be, they have a pretty basic policy, your dwelling's going to be covered, your personal property, those types of things, but they don't have a lot of optional coverages. Like some companies will give you like expanded replacement cost and sewer line coverage and, all these different enhancements that you can get to make a better policy. Citizens doesn't offer a lot of those. It's pretty bare bones, basic. policy. Also, they only offer 100,000 limit on their liability. So you can't get any additional coverage, where on a regular policy, you can usually increase it from 100,000 to 300,000 for like $20 a year. It's 100% worth it. You should always do that. Citizens doesn't have that option. And then the last thing that applies to both homeowners and investor properties is the risk of assessments. So with Citizens, you can get an assessment up to 45% of the policy premium if they run out of reserves. We had like 6 companies that went out of business last year because they weren't financially solvent anymore. Citizens, because they're backed by the state, can't go out of business. So if they run out of their reserves, they can do these assessments. They haven't had to do that in a long time, but as more and more people move to them, if you think if 3 houses in Fort Myers had Citizens and 3 in Orlando and 3 in Tallahassee, the chance of them running out of reserves and having to pay, do these assessments is very small. Now, if the entire city of Fort Myers and the entire city of Miami and the entire city of Tampa is all covered by Citizens and we have a storm again, then the chance of them having to pay out that much, the reserves can go very fast. And then the chance of having an assessment goes up. So that's always something you should take into consideration. I tell people if you're saving $200 to go with Citizens, it's not worth it. But if you're getting half price with Citizens, it might be worth considering. And I usually tell people in that situation, hey, put aside that extra 50% every month for that first year. And then you've created like a safety net for yourself where it won't impact your lifestyle if suddenly you have a 45% assessment. So that's kind of the way I look at those. And then on the landlord side of it, the other big thing is they don't offer ordinance or law coverage. Are you familiar with that? Or
yeah, but please go ahead and explain it. That'll be good for the audience.
So ordinance or law is something that covers the additional cost of compliance for codes. Like if you have a fire in your kitchen and now to get your permits and everything, you have to upgrade the rest of the electric in the rest of the house. The upgrades in the undamaged portion of the home come from ordinance or law coverage. The other thing, and this came up with the Surfside condo, if you remember that one last year that collapsed, you had half the building collapsed, half the building was still standing. The solution that they came up on that is that we're going to knock down the other half that's still standing. We're going to demolish it. So ordinance or law can cover the undamaged portion for demolition if that's what you're required to do with that. So Citizens landlord policies does not offer that coverage. So that's one of the things that's missing that you normally get with other companies.
Gotcha. Which could be a big one, especially
can be. One of the other examples I've heard that's a big one you don't think about is coastal properties that like the old code, they were just built on a slab or whatever. And now current code is they have to be elevated. So if you imagine having to, like, you have a small fire and now to get your permits, you got to elevate this thing, like that'd be a huge cost. So it's an important coverage in a lot of cases, especially on older homes.
Yeah, I can see that being a little bit of an issue. You got to all of a sudden put the house on stilts, right?
Yeah.
How do I do that?
Right. Yeah, I don't even know, but I know it would cost a lot.
Yeah, it definitely would be kind of pricey, right?
Yep.
You could just get your car jack and little by little, no?
Yeah. So, liability was the other thing you said you wanted to talk about a little bit. So liability is one of the most important coverages that you can have, and it is not very expensive for the coverage that you get for it. So if you have someone that slips and falls, if you have, someone that's fell off the roof, or someone that, got bit by a dog, those types of things can potentially be covered under liability. Some companies have some exclusions and restrictions for certain things like that. But overall, it's going to cover the actual settlement and the cost of defense. So even if someone sues you and it's a dumb lawsuit that no one should ever get anything for, you can still run up a lot of attorney fees defending yourself in that claim. And so your liability insurance is going to help protect against that. So you should, I talk to some investors that have a big enough portfolio that they want to self-insure. And that's great if you can, if it makes sense, can you afford the claim if the claim happens? And what's the chance that you're going to have multiple claims? If you have all your houses out there on Fort Myers Beach and the hurricane comes, you're going to have the claim for all of them. Can you cover that or not? If they're spread out, your risk's a little bit lower. So that's always something to consider. But the liability part of it, you should never self-insure liability, in my opinion. The cost is never makes sense on that.
Fully agree with that one. I have a lot of friends and clients that when I first met them, they own a ton of condos, and it's condos. You don't need insurance. You need liability insurance at least.
Yeah,
it's easy
absolutely.
to repair the inside of a condo. It's not that expensive, but somebody getting hurt in your condo can
Right.
run up a big bill.
Yeah, absolutely.
So that's definitely a really big, important one for all of us investors team. So make sure you protect your assets. Greg, as we're wrapping it up, share with us your final thoughts. Anything else you'd like to share with the team, with the audience here?
Yeah, I think we touched on a lot of it. You have my contact information on the screen there. So if you have any questions, I'm always happy to help. Also, we have our Florida Landlord. So we have ThinkSafeInsurance.com for all of our insurance. And then Florida Landlord Insurance is where we put most of our stuff geared towards investors. So we have some information on, buy and hold, vacant, Airbnb, all of that type of stuff, as well as resources that we found helpful through the years as well. Yeah, so that's pretty much it. I'm always happy to help, always happy to talk insurance. So feel free to reach out if you have any questions.
Thank you so much for that, Greg. I got a very important question from my buddy Zach. He asked, do you have avalanche insurance?
Avalanche insurance. I'm sure you could probably get it. We don't have it in Florida.
I love it. Thank you for that question, Zach. I do appreciate it.
Yeah, good question.
Team, feel free to reach out to Greg. His phone number is here on the screen, his email, take a screenshot. Always know that there's one thing to know about Greg. He's happy to share information. He's happy to educate you. I just referred him to a friend that's moving from doing business in Vegas to doing business in Florida. About an hour and a half after he called Greg, he calls me like, "Oh my God, he gave me so much good information." That's the kind of person that he is. Right off the bat, he's going to share information with you, and he's always going to go above and beyond to help you out. So thank you so much for being here, Greg. Really do appreciate your time and your knowledge. It's always helpful to talk to you, man.
Absolutely. Well, thanks for having me. It was great to meet you guys in person. Well, on Zoom, but see the faces, and I'm always happy to help. So talk to you guys later.
Thanks, man.
Thank
Have
you,
a good
Greg.
one. Zach, love you too, buddy. It's good to see you here, man.
All right.
Where are we at? Who's next here today? Any questions, ladies and gentlemen, before we wrap it up? If not, once again, thank you all so much for being here, enjoying Free Week. If you want to continue to enjoy the amazing experience that you've had, remember to sign up. It's relatively easy. You could go do it right now while we're talking, and you could be here Monday getting some greatness from Yates coming up. You're about to do some back trading, and just anytime that you get to spend with Yates, it's always amazing.
Amazing, yeah. All right, guys, and lastly, please, those on YouTube, those who are going to see us on YouTube later, please like and subscribe. The more likes we get, everybody says the same thing, because YouTube actually uses that algorithm. Any questions, any comments you have, please, realestate@reallifetrading.com. For what I was mentioning, for coaching information, if you want to reach out to us, we are here in reallifetrading.com/RE. Move it to the screen right here, okay?
Thanks,
This is
Lynn.
us.
Thanks, Ryan. Thanks, Zach. We appreciate everybody being here.
This is my buddy. That's the Ugly Mug. We offer coaching sessions. We offer personal mentoring. We are always around. You can see the rest of our videos, the rest of our content here. These are the books that we recommend you guys. If you really want to go and start going into real estate, please make a screenshot of that. Those are the books that we read, we recommend, and they're going to put you to the great path. Again, any emails, any questions, anything, we're there.